Hi friends, let's talk about the most asked DMs topic lately, stablecoins. Thanks. On May 20th, US Senate passed the Stablecoin Innovation Act. Then Hong Kong, EU, Singapore, UK, South Korea, and others approved restricted token regulations. Multiple stablecoin legislative drafts were introduced this year, and China's PBOC Governor Pan Gongsheng publicly discussed them for the first time in June. Meanwhile, Circle, the first stablecoin-related stock, saw its share price soar by 750% within a month post-IPO. Companies controlled by the Trump family have also issued their own offerings. Payment giants like PayPal, Stripe, Morgan Stanley, Goldman Sachs, JD.com, Ant, and Xiaomi lead the stablecoin space. Many people might subconsciously think crypto concepts are merely trends. They may view it as profit-driven or an American conspiracy. Yet numerous governments and major global companies have embraced it. It's not just about making money or knowingly entering traps. Stablecoins are integrating into the financial market, explaining the sudden surge. Let's take a deep breath and understand the chaotic battleground of stablecoins. First, we'll talk about the characteristics of stablecoins and some basic market conditions. If you want to see what the US is thinking or what other countries are doing, you can skip to that point. Stablecoins are a type of cryptocurrency like Bitcoin and Ethereum built on the blockchain. The biggest difference is that they are stable. Most stablecoins are pegged one-to-one with the US dollar. Currently, private companies can issue their own stablecoins like Tether, the largest by market cap. USDT is issued by a company called Tether. You can exchange $1 with Tether, and Tether takes that dollar and creates a US dollar worth of USDT on the blockchain, stored in your wallet. You can freely circulate this coin in most of the crypto space. You can use it to pay, trade, invest, etc. Let's think a bit deeper. Why can Tether ensure that USDT stays stable at $1? Why doesn't it fluctuate like Bitcoin? It ensures that I can both obtain a coin for $1 and redeem it at the same price. In other words, both its purchase and selling price is $1. With an unlimited $1, when the market price exceeds $1, buy from Tether and sell on the market. If below $1, purchase from the market. Selling back to Tether stabilizes the market price at $1. Tether guarantees unlimited redemptions by holding at least $1 in reserves per issued coin. This stablecoin is backed by dollars as collateral, requiring a 100% reserve, similar to the early days when the Federal Reserve issued gold-backed dollars. For example, Tether's Q1 report shows issuance of 143.68 billion coins and reserve assets of 149.7 billion. They should have a 5.6 billion surplus. You don't need to understand blockchain or cryptocurrencies. It's like a gaming company. QB, its own game coin, is value-backed by collateralized assets. Also, decentralized stablecoins rely on collateral backing. Purely algorithmic stablecoins are small. Currently, the main stablecoins are two, with Tether USDT accounting for about 60%. The other is USDC, recently launched and issued by Circle, representing 24%. Both are stablecoins issued by backed companies, as mentioned earlier. Various legislations in different countries are targeting stablecoins, which is ironic since blockchain technology is decentralized. Mainstream blockchain currencies still rely on centralized institutional models. The profit margins of stablecoin issuers are terrifying. Tether made a $13 billion profit last year with just over 100 employees, resulting in over $100 million profit per person. How do stablecoin issuers make money? It's simple. When issuing stablecoins, you give $1. They rely on investment interest. They invest in stable short-term government bonds or overnight reverse repos. With current high US rates, they can earn substantial interest. For example, Tether. They have issued $150 billion in USDT. At 4% interest, that's $6 billion per year. I estimate a company issuing a yen stablecoin years ago would likely be broke. And another stablecoin issuing giant Circle has been able to grow so rapidly because it heavily depends on exchanges. In 2024, interest income was $168B, with over $1B distributed to exchanges, which used it for replenishing, incentives, and rebates to attract users. When users deposit USDC, the platform offers annual returns plus subsidized profits, resembling the incentive cycles of credit cards. A bit off track, haha. Let's talk about why so many people see stablecoins as very important. Not only can it be used as a cryptocurrency, but it also has clear advantages in some real economy transactions. It's exceptionally convenient, especially compared to traditional bank-based cross-border remittances. Less common currencies have fees above 5% and may take days, but blockchain stablecoins avoid delays. No currency conversion, bank integration, or SWIFT. Funds arrive in minutes with lower fees and high privacy. Trading in-game currency is like dealing with 9 billion teenage girls' dream, unaware it's actually your neighbor, Lao Wang. The crypto world's key difference from gaming is its blockchain base, making all ledgers public. Actually, the convenience and privacy are advantages inherent to all cryptocurrencies. This is why people used to hype Bitcoin, yet at the same time, stablecoins have filled Bitcoin's biggest gap. They are stable, convenient, and private, making stablecoins an ideal transaction currency. Although in early stages, they have already attracted significant interest. Many economic activities require these three characteristics. Firstly, an obvious example is the black market. Previously, many people used Bitcoin for money laundering but found it unstable. Now, stablecoins have addressed this drawback, naturally attracting numerous underground transactions. Another one is cross-border payments we mentioned earlier. A year and a half ago, stablecoin application in cross-border payments was almost zero. Now it's about $50 billion monthly. The cross-border payment market continues growing at 20 to 30% monthly, reaching a global size of $200 trillion annually. So you see, the ceiling is still quite high. This is also why companies like Amazon and Walmart, which you initially thought had nothing to do with cryptocurrencies, are now leading in stablecoin deployment. Another currently major application is in those countries with high inflation, somewhat similar to using a digital dollar. Since 2020, citizens in Argentina, Nigeria, Brazil, and Turkey have faced rapid currency depreciation, leading governments to impose strict foreign exchange controls. How should we respond? People in these countries have widely adopted stablecoins for transactions and payments. Initially, governments of these countries reacted by prohibiting and restricting stablecoins, but faced strong public demand. Unable to hide it, they changed attitudes with a complete turnaround. Actively support stablecoin pioneers. Instead of using black markets, I'll embrace openness and flow. I will launch stablecoin pilots in Brazil's payment system, and in Argentina, they can legally be used to pay rent and more. Global stablecoins now exceed $250 billion, a 20-fold increase in 5 years, yet still lag behind Bitcoin's $20 trillion. It's only about 1%, but in terms of trading volume, stablecoins have already surpassed Bitcoin, indirectly confirming their strong monetary attributes. In 2024, stablecoin trading volume reached $27.6 trillion, surpassing Visa and MasterCard's total payments despite its infancy. Total payments show significant potential. To introduce development, we primarily focused on positive attributes. Despite benefits, it has many risks, including speculative traits linked to money laundering. The US might face a major crash or fraud. Naturally, public perception isn't favorable, which is why most countries' authorities have been wary of stablecoins. But part of the reason is the lack of clear regulations in many countries. Ambiguous laws leave uncertainty about what is legal and compliant. Due to red lines, most multinational companies avoid this field, causing cryptocurrency participants to concentrate on making money and speculation. Why has the recent strict national legislation been a major positive for stablecoins and the crypto industry? Countries have recently started enacting extensive legislation as a response to great power and currency competition, with the United States as the main driver. Let's examine the main actions Trump has taken on cryptocurrencies since taking office this year. In January, upon taking office, Trump signed an executive order titled Strengthening U.S. Leadership in the Digital Financial Technology Sector, which prohibits digital dollars. This basically set the tone. I absolutely support cryptocurrencies. Also in January, Trump issued his own Trump coin, 80% of which is controlled by companies under Trump. This is not a stable coin. Like Bitcoin, its price fluctuates. It once exceeded $80 with a total value of $60 billion, but has now dropped below $10. In a few days, Trump's wife issued her notes and his son released a coin. In March, Trump classified seized government bitcoins as the U.S. Strategic Crypto Reserve, prohibiting their casual sale. Later, a Trump-associated company issued another stablecoin, USD1, initially small at $100 million. By May 1st, it surged over tenfold to $2.2 billion. What's going on? It's because Abu Dhabi came in and the Abu Dhabi Investment Authority suddenly invested $2 billion. To be honest, for a U.S. president to issue his own coin, I may not be very familiar with U.S. law, but I am quite surprised by this behavior. It's very obvious that there is a conflict of interest. The key is what the market's reaction seems okay, indicating that whatever Trump does is generally well accepted. Of course, The real game changer for the stablecoin market is this Genius Act. It's called the Genius Act not because Trump thinks the bill is genius, but because its abbreviation happens to be genius. The Senate passed a stablecoin bill with strong votes on June 17th, but it awaits House approval as a draft. It's less convoluted than the Big and Beautiful Act, which exceeds 1,000 pages. It's about 20-30 pages, allowing me to outline its core elements. It's largely standardized not only in the US, but also in most other countries' legislations. They're similar. I'll summarize the main points briefly. Companies issuing stablecoins must be licensed by the government, which determines who can issue, though it's unclear whether state or federal authorities decide. This is still being debated. Regarding regulation, it has specified which agencies are responsible, but everyone doesn't need to know that. All stablecoins must maintain high-quality liquid reserves like short-term government bonds or overnight reverse repos and cannot use these assets for further collateralization. Reserves have the highest liquidation priority. If the stablecoin issuer goes bankrupt, reserves go to holders instead of debts. Additionally, there are some risk management requirements, disclosure and transparency requirements, anti-money laundering requirements, and so on. After banking experience, you find the standard trio requirements familiar, but their reserve asset rules exceed banking regulations. Do you seek 100% reserves? These companies, it's akin to issuing currency. If banks commit heavily to compliance, crypto companies must do even more. Let's briefly discuss compliance. Compliance is adhering to the laws and regulations of various countries, including licenses, audits, anti-money laundering, technical security, and reserve asset requirements. Now, countries need to first introduce these regulations to make compliance feasible. For example, although tie-dye coin currently has a market presence, insufficient disclosure and British Virgin Islands registration, not US-based, may exclude it from the US market. Compliance is crucial for stablecoin issuers and even more so for exchanges. Early markets lacked regulations, allowing trading platforms to grow rapidly. In the past 2 years, standardization of regulations has major exchanges are consolidating. For example, the large cryptocurrency exchange OKX settled with the US Department of Justice in February, paying an $84 million fine. They forfeited $420 million in revenue and shut down Web3 on-chain transactions after finding illegal groups using wallets for money laundering. You saw in the news they suffered heavy losses this year due to compliance, recognizing its importance and deciding to act accordingly. To comply with DOJ regulations, they paid fines for their Web3 wallets, on-chain transactions, and voluntarily shut them down, addressing European and US authorities. We prioritize compliance and security. We are performing well and are a law-abiding exchange. Although regulations don't require exchanges to hold reserves, they've issued 100% reserve proof reports like stablecoin issuers monthly since February. Users can verify if their funds are backed by a one-to-one reserve. By acting proactively, they successfully obtained licenses in regions such as the US, EU, Singapore, Dubai, and others. Complying with regulations brings significant initial costs to crypto companies, but ultimately offers huge benefits in user and regulatory trust. Recently, rumors emerged that OKX may list on the US stock market despite their previous efforts and fines. Shutting down the wallet's on-chain transactions makes more sense. Listing on the US stock market holds unusual significance in the crypto circle. To them, it is equivalent to a very strong compliance certificate for the US market. To be honest, these crypto companies are not really short of money. What they lack is credibility and certification. This is the biggest benefit of their US stock listing. It greatly enhances their credibility with users, investors, partners, and even regulators. Do you know why? Coinbase has always been considered a model student for crypto compliance, and even the newly listed Circle has done the most and most thoroughly in compliance. It helped them lead and capture most of the US market early on. So why? To summarize, it has three main purposes: maintaining the US dollar status, increasing demand for US Treasury bonds, and securing a position in the crypto world. Some suggest Trump aims to profit, as shown by his many coin issuances. However, we won't address that. Instead, we'll focus on the first 3 points, beginning with strengthening the US dollar's status. In March, Treasury Secretary Bassett stated the Trump administration would use stablecoins to sustain the dollar's dominance, as mentioned before. Since Trump took office, many countries and markets are slowly de-dollarizing, a trend the US government clearly opposes. Stablecoins can be pegged to euros, offshore RMB, or gold, but in reality, 99% of the market now Stablecoins remain tied to the US dollar. Promoting them short-term effectively supports the dollar despite on-chain transactions. They are also pegged to the US dollar exchange rate. For example, Turkey, Nigeria, Argentina transact using US dollar stablecoins. These countries would cease using their own currencies like lira, naira, and peso, rendering their interest rates meaningless and effectively relying entirely on the US dollar. Fully dollarized, widespread use of USD stablecoins in non-dollar countries would enhance the US dollar's usage and international status. This is easy to understand. Stimulating US Treasuries demand is next, since most stablecoins are dollar-pegged, with 60% of reserves in short-term government bonds. After legislation, Tether, the largest stablecoin issuer, might increase. In 2024, net purchases of U.S. Treasuries reached 33.1 billion, making it the seventh largest global buyer, Besant noted. By 2028, stablecoin scales may grow eightfold and demand for short-term U.S. Treasuries could exceed $1 trillion. This benefits the U.S. Treasury, which fears buyer shortages, a widely noted point. Although this logic is straightforward and reasonable, I don't believe it's the main reason the U.S. is quickly introducing stablecoin legislation. This is my personal opinion. While U.S. Treasury's demand isn't new, the key factor is the government bonds' maturity. Tether is regarded as the largest holder of government bonds, purchasing substantial U.S. Treasuries based on their bond holdings. However, maturity is crucial for U.S. Treasuries, Mingpao, Canada, Toronto. Most stablecoins hold ultra-short-term government bonds with maturities under 3 months, whereas entities like Japan's central bank and foreign reserves buy medium to long-term bonds lasting 3 to 30 years. These two are entirely different concepts. Friends who have traded understand that 3-month Treasury bonds differ fundamentally from 10-year ones, and that market demand doesn't decisively influence ultra-short-term interest rates. The Federal Reserve's 25 basis point rate cut may be too large compared to 10, and buying Treasury bonds is useful. This part is briefly covered without detail. The U.S. government doesn't sell ultra-short-term Treasury bonds, fearing the long-term ones discussed earlier in the Haihu Manor Agreement. Didn't he also recommend other countries exchange short-term Treasury bonds for long or ultra-long-term ones? If buying short-term, I prefer all converted. Anyway, if you suggest the US introduced urgent cryptocurrency legislation creating massive uncertainty in the crypto world, I'm skeptical about demand rising for $1 trillion in short-term after 3 years. Increasing Treasury bond demand is beneficial, but not the US's main purpose. The other 2 points are more important. Let's examine the third point, struggle for discourse power in the crypto world. The US previously took a wait-and-see approach to cryptocurrency, but has now recognized that the crypto world is more than just talk. Demand is growing, concepts updating, and traditional financial systems are being challenged. Since they can't restrain me, I'll embrace leading in legislating and standardizing stablecoins. This objective is shared not only by the US, but also by supporting nations. The US isn't the first. Europe, Singapore, and Hong Kong have introduced stablecoin proposals. Additionally, the Middle East and Switzerland strongly support blockchain. So it can't be said that the US is just trying to be first. It's actually for the purpose of to not lose its position as the global reserve currency in the new battleground of the crypto world. They can only hasten clean legislation. Now, let's talk about China. Mainland China has always banned cryptocurrencies and is now primarily promoting the digital RMB. Differs significantly from stablecoins. We'll discuss that later. As the US aims to seize a leading position in stablecoins, China fears missing the opportunity to boost offshore RMB influence and is currently piloting its own stablecoin. The pilot for the RMB stablecoin adopts a dual-track system. Hong Kong introduced a stablecoin regulation draft in May, which will take effect on August 1st once released. Stablecoin-related stocks soared over 70%, showing strong market optimism for Hong Kong's stablecoin market. The main promoted stablecoin isn't US dollar-based, but Hong Kong dollar-based, also planning to pilot offshore RMB stablecoin. The concept of this regulation is similar to the US. Let's discuss a few aspects. Hong Kong's sandbox approach conducts pilot projects in an isolated, fully controllable regulatory environment. In July 2024, 3 sandbox participants received licenses, marking Hong Kong's first batch in the stablecoin sector to obtain licenses. Jingdong Coin Chain, Yuan Coin Innovation, and a partnership with Standard Chartered Bank show this is from Jingdong. Changxing Bank is its custodian bank. Its major shareholders are Xiaomi, Futu, and Yuan Coin Innovation. Its backing is primarily crypto capital. The third alliance includes Hong Kong Capital and another partner. Although not a sandbox participant, it aims to join to secure upcoming licenses. Ant Group exemplifies that even before Hong Kong's stablecoin regulations take effect, the competition for licenses has started. Hong Kong emphasizes cross-border payments, exemplified by the Hong Kong Monetary Authority and People's Bank of China launching the Dajing payment system on June 22nd. Secondly, it enables direct connectivity between mainland and Hong Kong, easing complex cross-border transactions for smoother fund flows. This payment system is not based on blockchain. It uses distributed ledger technology and is highly compatible with the digital RMB stablecoin, making it a key path for RMB stablecoin internationalization. The EU passed MiCA regulations for crypto assets in 2023, and Singapore's Monetary Authority released a stablecoin regulatory framework same year. These two are the first formal regulations to be released. To simplify understanding, I categorized various countries' attitudes towards stablecoins. First are the proactive and open-minded categories. Examples include Singapore, Hong Kong, and the UAE, particularly the UAE, which leads the crypto circle by allowing anything permitted elsewhere. In the UAE, as long as it's legal, you can try. To major crypto companies, feel free to set up here, low taxes and a welcoming environment. Hong Kong and Singapore, key global financial and trading hubs, continue to vie for Asia's leading position, ensuring they remain competitive in the emerging crypto race. They eagerly began competing in stablecoins under Singapore's 2022 Financial Act. It clearly stipulates that entities registered in Singapore providing digital token services to overseas clients must obtain a license to operate legally. The second category, I call the cautious and inclusive type. Primary regulators are the US and EU. Despite EU's early regulation, its approach is more cautious than the US. For instance, MiCA stipulates that charging token redemption fees and stablecoin interest is prohibited, and pre-issuance amounts are limited to ensure financial stability. Stable payment systems, monetary policy transmission, and sovereignty face risks. Notably, several restrictions exist, especially the severe ban on stablecoin interest payments. Presently, numerous stablecoin platforms offer users interest on their holdings, resembling traditional deposits in the cryptocurrency sector. However, if the EU mandates stablecoins cannot pay interest, this approach diminishes stablecoins' appeal, signaling that Europeans prefer not to engage with flashy financial instruments, reflecting their specific attitude towards stablecoins. Cautious with a hint of rejection, rather conservative. Before 2021, South Korea opposed cryptocurrencies, especially after the 2022 collapse of Luna, which caused investors to lose over $4 billion. South Korea introduced strict regulations stating, "Don't cause problems again." Despite this, the private crypto market remains vibrant. With new President Lee Jae-myung, his campaign platform clearly shows a friendly attitude towards stable and digital assets. South Korea also just proposed a basic digital asset bill in June. Many countries have had similar attitudes towards stablecoins as South Korea in the past year: cautious, accepting, embracing. The third category includes clear restrictions, primarily mainland China, along with Bangladesh and Afghanistan. I'll expand a bit. Today we're mainly discussing stablecoins, but various countries also aim to promote tokenization. This involves RWA, real-world assets, a popular blockchain concept meaning real-world assets. Don't worry, it's simple. Basically, it's digitizing some real-world assets and putting them on the blockchain. For example, if I own a house in the real world, I can create a corresponding mapped asset in RWA on the blockchain. You can place corporate bonds and intellectual property on the blockchain. They cannot be tampered with. Transactions are transparent and open, and you can even attach smart contracts. Look, this stablecoin is actually a type of RWA. It represents real-world US dollars on the blockchain. In March this year, BlackRock partnered with Securitize to jointly on the chain released a US dollar money market fund named BWED, placing an investment fund on the blockchain. Invest with stablecoins and periodically receive more stablecoins as returns. To be honest, many financial maneuvers occur on the blockchain, so creating an investment fund isn't surprising. The key point is a known company is issuing it. BlackRock, the world's largest asset manager, issued this $2.9 billion fund. It's impressive a major financial firm entered so early and successfully at large scale. To be honest, I'm surprised that in China, companies like Ant also actively research and promote RWA and engage in Hong Kong's Sandbox project. charging station RWAs, photovoltaic RWAs. These projects can raise funds on the blockchain, and everyone can also invest on the blockchain. Exclusive Yo-Yo television series exclusive. Regarded by Hong Kong and Singapore as a promising sector in the crypto world, RWA is a key battleground for stablecoins, now progressing rapidly. OKX recently launched OKX Pay, allowing users to scan each other's QR codes within the app and transfer funds instantly. It's similar to Alipay, but you transfer stablecoins and manage your balance in your wallet like Bao. Furthermore, online payment giants like PayPal and Stripe have already incorporated stablecoins into their payment systems. Major companies worldwide join the stablecoin battle, reflecting the adage, if you can't beat them, join them. Initially, most companies and governments from various countries might have rejected it. After all, the majority are vested interests of the existing market system. But when some of them gradually realize that this trend seems irreversible in the short term, what if they can't beat it? Then they'll join it and take the lead. The more people turn to the stablecoin market, the stronger this momentum will be. In fact, facing this trend, everyone wants to strive for their own benefits. The US using stablecoins to strengthen the dollar? Yes. Do other nations use stablecoins to gain favorable positions? Yes. Yes, Trump himself intends to profit from cryptocurrencies. Similarly, companies in the crypto sector aim to make money through stablecoins and cryptocurrencies. While objectives differ, everyone employs methods to promote and cryptocurrency market growth. Similar to trends where everyone is heavily investing in AI and robotics, the stablecoin wave also involves multiple governments. Various countries' regulations and central banks' involvement turn into a global scramble. We have briefly analyzed some countries' specific strategies and legislative purposes. To explore further, governments may require deeper examination. They probably haven't figured it out yet. Don't assume all legislators in stablecoin debates are crypto experts. There are few specialists, as seen in the US Congress with only the top 50 senators. Only around 20% fully grasp stablecoins over cryptocurrencies to vote on the crucial stablecoin bill, while 80% take a step-by-step approach. Don't be ridiculous. Widespread stablecoin adoption could significantly impact the existing financial system, broadly indicating substantial changes. Includes decentralized finance. Essentially, it skips traditional finance, bypasses payment companies. There's a term called financial disintermediation. Banks and payment companies are nervous and rushing forward. In 2023, JP Morgan CEO Jimmy Dimon declared Bitcoin a significant scam. They recently issued Morgan coins, and by 2025, major European and US banks and fintechs are expected to launch stablecoins. According to regulators, stablecoin issuers must have 100%. Most of these funds should theoretically return to the banking system, so the money flowing out shouldn't be significant. But what is the problem? It will lose a lot of liquidity and much of its lending capacity. Therefore, its interest will be greatly harmed, reducing the bank's connection with the entire economy. Although harm to the bank may not concern everyone, the weakened economic link is significant as the central bank depends on it. The banking system regulates monetary policy. Weakening this connection reduces the central bank's effectiveness. In the crypto world, managing stablecoin circulation speed regulates monetary policy. The significant scale of stablecoins is a major issue, yet global regulators deliberately overlook it. For instance, the US classifies stablecoins as payment stablecoins, meaning that they are primarily used for payments rather than saving, investing, or financing. Nearly all countries, not just the US, are banning or strictly restricting stable payment rates. By deliberately avoiding stablecoin interest rates, we're gradually addressing the issue step by step without including lending. Stablecoins are fascinating. I can't cover all aspects in one video, but I hope this content enables everyone to appreciate them. It's not that simple. It has triggered many significant clashes. It has sparked clashes between different countries' currencies, between traditional financial systems and crypto trading systems, and conflicts between private companies and regulators such as central banks balance stability and innovation. Although this innovation carries significant risks, many countries actively embrace it, and honestly, I'm excited. What form can Web 3.0 take to revolutionize our understanding? Thank you, everyone.